In the bustling world of finance, there's a fundamental concept that underpins every investment decision: valuation.
Simply put, valuation is the art and science of determining the worth of an asset, whether it's a company, a piece of real estate, or even a work of art.
Imagine you're at a bustling marketplace surrounded by vendors hawking their wares. Each vendor claims their product is the best, offering tempting deals and promises. How do you decide what to buy and at what price? You wouldn't just blindly trust their words, would you?
Exactly. Valuation is like having a discerning eye in this marketplace, allowing you to cut through the noise and assess the true worth of what's on offer.
So, by understanding valuation, I can identify undervalued assets, avoid overpaying for hyped-up investments, and ultimately make sound financial decisions.
Exactly. Whether you're a seasoned investor or just starting your journey, a solid understanding of valuation is essential. It's the compass that guides you through the complex world of finance, helping you navigate risks, identify opportunities, and ultimately achieve your financial goals. So let's delve deeper into the fascinating world of valuation and unlock the secrets to making smart investment decisions. Beginner investor. Why do we value companies? This question seems fundamental to investment analysis. Valuation expert. Valuation provides a crucial framework for understanding the financial health and potential of a business. Beginner investor. How does it help investors?
Valuation expert. It helps investors make informed decisions about buying, selling, or holding stocks. There are numerous scenarios where valuation becomes paramount. Beginner investor. Can you give an example?
Valuation expert. When considering an acquisition or merger, companies rely on valuation to determine a fair price for the target business. Entrepreneurs seeking funding from venture capitalists or angel investors must present a compelling valuation to attract investment. Beginner investor. What does the process of valuation involve? Valuation expert. The process of valuation involves a combination of art and science.
It requires a deep understanding of financial statements, industry dynamics, and economic trends. Analysts use various methods such as discounted cash flow analysis, comparable company analysis, and precedent transaction analysis to arrive at an estimated value for a company. Beginner investor. So by understanding valuation, I can make better investment decisions?
Valuation expert. Absolutely. By embracing the principles of valuation, both novice and experienced investors can navigate the complexities of the market and make informed decisions that align with their financial goals. Welcome to our discussion on valuation methods. Today we have Robert, a beginner investor, joining us to learn more about this topic.
Thank you for having me. I'm eager to understand the different approaches to valuation.
Great. In the realm of valuation, there isn't a one-size-fits-all approach. Analysts employ a variety of methods, each with its strengths and weaknesses, to determine the worth of a company.
That sounds interesting. What are the primary approaches used?
Three primary approaches stand out: intrinsic valuation, relative valuation, and contingent valuation.
Could you explain what intrinsic valuation is?
Certainly. Intrinsic valuation focuses on the inherent value of an asset based on its fundamentals. This approach involves forecasting the future cash flows a company is expected to generate and then discounting those cash flows back to their present value.
I see. What about relative valuation?
Relative valuation takes a comparative approach, valuing a company by comparing it to similar businesses in the same industry or sector. By analyzing multiples, such as price-to-earnings ratio or price-to-book ratio, investors can gauge whether a company is overvalued or undervalued relative to its peers.
And what is contingent valuation?
Contingent valuation comes into play when valuing assets with significant uncertainty or contingent events. This method is often used in industries like natural resources or pharmaceuticals, where the future success of a project hinges on uncertain factors like exploration results or drug approvals.
It sounds like each method has its own unique applications. How do experienced investors decide which method to use?
Experienced investors often use a combination of methods to arrive at a more comprehensive and reliable estimate of value.
Thank you for the insights. This has been very enlightening.
You're welcome, Robert. I'm glad I could help. Imagine trying to understand the human body by studying individual cells in isolation. You might learn about the function of a single cell, but you'd miss the intricate interplay of organs, systems, and processes that make up a living, breathing human.
So, how does this analogy apply to valuing a company?
Similarly, valuing a company requires more than just analyzing financial statements in isolation. It demands a system-thinking approach, a holistic perspective that considers the interconnectedness of various factors influencing a company's value.
What exactly is system thinking and valuation?
System thinking and valuation involves understanding the company as a dynamic system with inputs, processes, outputs, and feedback loops. Inputs include factors like market demand, competition, and regulatory environment.
And what about the processes?
Processes encompass the company's operations, management team, and strategic initiatives. Outputs are the financial results, market share, and customer satisfaction.
So, by embracing a system thinking approach, investors can gain a deeper understanding of the drivers of value for a company?
Exactly.
Section 5, Deep Dive Demystifying Telecom Valuation with DCF.
Welcome to our deep dive on telecom valuation using DCF. Today we have Robert, a beginner investor, joining us. Robert, what would you like to know about telecom valuation?
Thanks for having me. I've heard that the world of telecommunications presents unique challenges for valuation. Can you explain why that is?
Absolutely, Robert. The discounted cash flow, or DCF analysis, is a relevant approach for valuing telecom companies. It involves forecasting future cash flows and discounting them to present value.
Interesting. Why is DCF particularly suitable for telecom companies?
This method suits telecom companies due to predictable, recurring revenue from long-term contracts. Analysts project free cash flow over a specific period, typically 5 to 10 years.
How do analysts go about forecasting these cash flows?
They forecast key financial metrics like revenue growth and operating margins. The discount rate reflects the company's risk profile and opportunity cost of capital.
What makes the discount rate so important in this analysis?
The discount rate is crucial because it accounts for the capital-intensive nature of the telecom industry. By subtracting net debt, analysts determine the equity value for shareholders.
Thanks for the insights. This really helps demystify the process for me.
Glad to help, Robert. Understanding DCF is a valuable skill for any investor looking into telecom companies. Welcome to Section 6, Telecom's unique web navigating regulatory risks and debt and valuation.
So, valuing a telecom company seems really complicated. Can you explain why regulatory risks and high debt levels are so important?
Absolutely. Valuing a telecom company is like navigating a complex web. Regulatory risks and high debt levels are two of the most prominent threads that can entangle an investor's analysis.
Can you give an example of how regulations affect telecom companies?
Telecom companies operate in heavily regulated environments, subject to government oversight on issues like pricing, spectrum allocation, and net neutrality. Changes in regulations can significantly impact a company's profitability and growth prospects.
What happens if a new law is introduced?
For instance, a new law promoting competition could lead to lower prices and reduced market share for incumbent operators.
And what about the debt levels? Why do telecom companies have so much debt?
Telecom companies often carry high levels of debt because building and maintaining vast networks require substantial capital investments. This leads companies to rely heavily on debt financing.
So debt can be both good and bad for a company?
Exactly. While debt can amplify returns, it also increases financial risk.
Thanks for explaining. It sounds like understanding these factors is crucial for making informed investment decisions.
By incorporating regulatory risks and debt considerations into their analysis, investors can make more informed judgments about the true worth of a telecom company. Section 7, Beyond the Numbers, a glimpse into fundamental and technical analysis.
Aswath, can you explain why quantitative methods like DCF analysis are important for valuation?
Absolutely, Robert. While DCF analysis provides a structured framework for valuation, it's essential to remember that numbers alone don't tell the whole story. Fundamental and technical analysis are two complementary approaches that can provide valuable insights into a company's prospects, enriching the valuation process.
What exactly does fundamental analysis involve?
Fundamental analysis delves into the core of a company's business, examining its financial statements, management team, competitive landscape, and industry dynamics. It's about understanding the underlying drivers of a company's performance and assessing its long-term sustainability.
And what do fundamental analysts look for in their evaluations?
Fundamental analysts scrutinize revenue growth, profitability margins, cash flow generation, and return on equity to gauge a company's financial health and growth potential.
How does technical analysis differ from fundamental analysis?
Technical analysis, on the other hand, focuses on the historical trading patterns of a company's stock price and trading volume. Technical analysts believe that past price movements can provide clues about future price direction.
So, combining these approaches can provide a more comprehensive understanding of a company's valuation.
Exactly, Robert. Using both fundamental and technical analysis together can give a fuller picture of a company's true value. Section 8. Managing the unknown, incorporating risk into your valuation.
Aswath, can you explain why risk is such a crucial part of every investment decision?
Absolutely, Robert. In the unpredictable world of finance, risk is an inherent part of every investment decision. Valuation, while providing a framework for assessing a company's worth, shouldn't be treated as an exact science.
So, how do we incorporate risk into the valuation process to make it more realistic?
It's crucial to acknowledge and incorporate risk into the valuation process to arrive at a more realistic and reliable estimate. Risk, in essence, refers to the possibility of an investment's actual return deviating from its expected return.
What are some common sources of risk in valuation?
In the context of valuation, risk can stem from various sources, including economic uncertainty, industry competition, regulatory changes, technological disruptions, and even management execution.
How do we account for these risks in our valuation models?
One way to incorporate risk into valuation is through the discount rate used in DCF analysis. A higher discount rate reflects a higher risk profile, reducing the present value of future cash flows.
So by incorporating risk, we get a clearer picture of the potential outcomes of an investment?
Exactly. By incorporating risk into the valuation process, investors can gain a more nuanced understanding of the potential upside and downside of an investment.
Section 9, Parting Wisdom, Practical Tips for the Budding Investor.
Embarking on the journey of valuation can seem daunting, especially for beginner investors.
Absolutely, it can be overwhelming. What practical tips would you suggest to navigate the market with confidence?
Focus on understanding the fundamentals of the businesses you're evaluating. Delve into their financial statements and assess their management teams.
That makes sense, but what about the market noise and short-term fluctuations?
Don't get swayed by market noise or short-term fluctuations. The stock market can be irrational in the short term, but value prevails in the long run.
So patience and discipline are key?
Exactly. Successful investing is a marathon, not a sprint. Never stop learning and expanding your knowledge. The world of finance is constantly evolving, and staying ahead requires continuous learning.
How important is it to seek guidance from experienced mentors or financial advisors?
It's invaluable. A fresh perspective and sound guidance can prove invaluable in your investment journey. Embrace valuation principles, focus on fundamentals, and approach the market with patience and discipline to achieve your financial goals.